This Wednesday, January 29th, with eyeballs focused on what's going on in the United States. With more, we're joined by Calla, mortgage expert with the Calla mortgage team. Thanks so much for joining us today.
You're welcome. Good morning.
So, is it going to be a good morning on Wednesday? What are you thinking? Where are things going?
We certainly hope so. I mean, the inflationary numbers are in our favor, but we have so many options. And I think with Canadians seeing all the consecutive interest rate drops, you might think that an adjustable rate mortgage or a variable rate mortgage is the way to go. And while that certainly has merit, over the last 20 years, we've seen how lenders have adapted and adjusted to these market movements that haven't always benefited consumers. So we're here to really break down those components to make sure that that's considered as we move forward.
And I think a lot of people are thinking, like, ooh, do we go with a variable? Because what if the drop? I mean, right now they're saying could drop a whole point this year. I think I'm not getting that wrong. We'll see. So yeah, a lot of people, what are the differences, I guess?
Well, there's four major considerations that you got to go into. First of all, adjustable and variable rates have significant benefits. They have 3 months interest penalty to exit. You can benefit significantly with these rate reductions, and they're easy to move into a fixed rate. But this year actually marks a decade where the Bank of Canada had rate reductions back in January 2015, in January and July, but those were not passed on to consumers in its entirety. So here we are a decade later, and we still haven't gotten the benefit from those reductions. So it's not automatically guaranteed. However, in our experience, it's most likely that it's passed along. But consumers are still waiting for those basis points to be passed along. Now, let's fast forward to 2016, Jennifer, and that was the first time in history that a major Canadian bank decided to create their own proprietary prime rate, which was slightly higher than any other bank's prime rate. And the consumers didn't notice because in their specific variable rate mortgage product, consumers didn't notice because the payment wasn't adjusted as you would see in an adjustable rate mortgage, but their amortizations grew. So as you're navigating variable rate, fixed rate, what is the compounding frequency? That independent move by a major Canadian bank really highlights the intricacies that in changing times, banks can also decide to make independent moves of the Bank of Canada. Now, let's not forget where we're getting our information, Jennifer. In 2021, Tiff Macklem, the governor of the Bank of Canada, came out and reassured Canadians that rates were going to be sustainably low. And with that confidence, Canadians took adjustable or variable rate mortgages with the intention that they were going to have sustained benefits. However, fast forward to 2022 and 2023, and we saw the largest rise in inflation and the significant rate surge. And so adjustable rate mortgage clients saw those rates go up rapidly along with their payments, and variable rate mortgages had grossly excessive amortization and even hit trigger rates. And right now, with this snapshot in time, what we're seeing is the discount in the variable rate mortgage is shrinking. So whereas consumers were very happy to see maybe prime minus 75, prime minus 1, now we're seeing that shrink into prime minus a quarter, prime minus a half. So the decision cannot be taken lightly,
No.
and history can show us how markets will adapt.
And so I guess with the tariffs, this potential tariff looming, how is that playing into all of this?
Well, that has given the Bank of Canada the opportunity to pause if they want to see how things are going to head up. And with the models that have been done by the economists alike, what we've seen is that this could put a pause on the significant reductions that we were expecting moving forward. And the short-term pain could be higher interest rates and increased inflation. So when you're making your consideration on what type of interest rate, while that will be most likely a short-term pain and not gain the benefit that Canadians are hoping, if they were hoping to take a variable rate mortgage, the long-term effect, because it will be so painful to Canadians, would be lower interest rates. But that's certainly something that can give the Bank of Canada the opportunity to pause. And so when you are making a mortgage rate selection, it's important to work alongside an independent professional that can help you adapt very quickly with the change in market. Because just being in here a few months ago, Jennifer, we're talking on set, and the adjustable rate mortgage was anticipated to be the #1 pick for 2025. Fast forward with the economic circumstances that we have today, it's not a decision that is certainly something that can be taken with certainty, with uncertainty looming. But you can build certainty into your mortgage with the right product, aligning yourself with an independent professional for unbiased advice to make sure that what you're looking at has all the details and security components you're looking for.
Well, thank you so much. People would like to get in touch with you. Where can they reach you?
Absolutely. They can reach me at angelacalla.ca, follow me on LinkedIn, and all of this is covered in the mortgage code.
Excellent. And it goes, proceeds go towards charities.
Yes,
so,
TCMG.
fantastic. Thank you so much, Angela Calla, joining us. Thanks, Angela.